Hi, good morning, everybody. Thank you so much for joining us on a Saturday morning for this webinar with ithoughtmfd. We'll wait for another few minutes to see if there are more people joining in, and then maybe we can start. You can just react with a thumbs up if the audio is clear and you're able to see my screen. Thank you. Okay, great. I think we can begin. If you all can hear me, can you just give me a quick thumbs up? Okay, great. Perfect. So once again, thank you all for joining us today on a Saturday morning for this webinar. It's going to be a very simple breeze through webinar. We're going to be discussing the basics of what a mutual fund is, how it can be an effective tool for investment, and there may be so many questions in our minds before we even start investing in a tool like this. So this webinar has been curated just to make it easier for the common population to understand what a mutual fund is, what are the various categories that are available, what types of funds are available, how exactly does a mutual fund work, etc. So without further ado, I will go on with the presentation. I'm so sorry, there's some technical glitch. Just give me a few seconds while I sort it out. There is some issue with my camera, so I'm unable to turn it on. Okay. First off, what is a mutual fund? I'm sure many of you all have heard of the term and the definition is available on the screen as well. But what, in your understanding, is a mutual fund? You can put your answers in the chat box. Does anybody want to give it a go on what is a mutual fund? What, in your understanding? Any answers are welcome. You don't have to feel scared or does anybody want to try as to what is a mutual fund? We'll have a few answers. There's no, oh, can you not see my presentation? So sorry, just a second. Are you able to see my screen now? Okay, perfect. Great. Mutual fund is a tool for investment of shares and securities. It's a pooled investment vehicle. It's a mode to invest in equity via an AMC. Yes, pretty much. That is pretty much what I'm going to cover. So at the core of it, mutual fund is basically a pool of money which is collected from multiple investors who may or may not share a common investment goal. We're all aware of individual stocks. There may be an ICICI Bank, an HDFC Bank, Hindustan Unilever, Maruti, etc. Those are all individual stocks. What a mutual fund is basically a collection of multiple of these stocks put together, and they pool money from various investors to put in a variety of these securities. And the biggest advantage of this is that when you invest in a single, say, equity stock, say an ICICI Bank, and there is huge volatility in that stock, there's going to be a direct impact on your money, and there's possibly no way to compensate for it. What happens in a mutual fund is, even though the mutual fund portfolio may have ICICI Bank, which has been very volatile, there will be other stocks as well in the portfolio that will perform marginally better, which will help your investments, right? So this collection of stocks that a mutual fund invests in is what is called a portfolio. So portfolio of stocks, essentially mutual fund pool of money collected from multiple investors. They put it in various securities like, say, equity or bonds, etc. And that collection is what we call a portfolio. So you think of it as a way for everyday investors to access a diversified portfolio without, say, having to research and manage individual investments by themselves. So there are people who may want to do their investments themselves, but when you want professional management of money, that's where mutual funds come in, right? They're designed to sort of offer easy and cost-effective ways and accessible ways to invest. It can be even the smallest of amounts. There is a certain misconception in the minds of a lot of people that you need a huge sum of money to be able to invest. You can start with as less as a 500 rupee SIP. So those are some of the biggest advantages of mutual funds. So professional management, diversification, liquidity, etc. And say, even if you're investing a small amount, you will gain the access to a larger and diversified basket of assets, which may be difficult to achieve if you did it on your own sometimes, right? So this is why mutual funds are sort of considered a very smart starting point for beginners and a very reliable vehicle. But there are many questions in our minds as investors. But before we answer those questions, what we have to understand are the basics, right? Some common questions are, what is an AMC? Is there a history to mutual funds? How do you pick a fund? What kind of returns can we make if we invest? What are the modes of investing? These are things that we will look as we move forward in the presentation. Some other questions that may arise are, what is an ideal amount for investment? Or say, do you need a large sum of money to be able to invest in mutual funds, etc.? So these are things that we will look at. Before we go on to that, let's look at how a mutual fund works. So it's a cyclical process, like you can see on this slide, right? Explain it in simple terms and then go into the details of it. Step one is where investors pool their money. Step two, fund managers, they do their due diligence, they do their research, speak to research analysts, etc., and they invest in stocks or bonds that they find suitable and best for their portfolio. And step three, these investments, they sort of generate returns. The money has been invested and that generates returns. Step four is where the returns are delivered to the investor. So if you want to look at it more technically, the income generated from the investment is distributed proportionally among the investors. Of course, after deducting all of the applicable expenses by calculating the NAV. What is an NAV? Now that I've mentioned net asset value, what is a net asset value? So just like how an equity stock, equity share has a traded price, right? A mutual fund has a net asset value per unit, right? So this NAV is basically the combined market value of shares, bonds, and securities held by a fund on any particular day, right? And since mutual funds are not traded in the stock exchange on a regular basis, it's not traded. What comes as its price at the end of the day is what is considered. So NAV per unit, it represents the market value of all the units in that mutual fund scheme on that given day, and net of all expenses and liabilities plus income accrued. So the formula is basically the market value, a net of all expenses, liabilities plus your accrued income divided by the number of outstanding shares. Right. So what happens in this process? So I'll give you an example, right? So imagine you and a group of friends, you each contribute 1,000 to a common pool. There's a professional investor, well, let's call that person a fund manager. He takes this 10,000 rupees. So each of you have contributed 1,000 rupees. So this 10,000 rupees he takes and he invests it across a variety of assets. So he will have a certain strategy in his mind. So I'll give you some examples of mutual funds. I'll name a few. There's, say, HDFC focused fund, ICICI focused, HDFC large cap. All of these mutual funds have a certain strategy of investing. They invest in a certain type of stocks, or they invest in a certain philosophy through which they in a variety of assets or in one portfolio of a mutual fund. So this pooled money is basically used to buy shares, bonds, or other instruments depending on the fund's goal. Some funds may have the goal to generate X amount of return. Some funds may have the goal to beat the benchmark. Some funds may have the goal to, sort of achieve that level of say the economy is performing a certain way, it will want to possibly perform contrarianly. So if the economy is not doing well, they will try and find ways to outperform the economy, right? So what happens once this money has been invested is when these investments generate income or they increase in value, the returns after deducting all of the management fee, expense ratio, etc., is given back to you, the group of friends who invested. So the 10,000 that you invested may have generated, say, a 5-6% return. If you invest in mutual funds, the average return that you make is 12.5%. So that income generated is proportionally distributed among all 10 of you, right? And this cycle continues. Funds, they're regularly reviewed. The assets may be rebalanced. There's something called portfolio rebalancing that's happening. So if you're aware, very recently, the Nifty 50 index was rebalanced. Rebalancing typically happens for most funds on a 6-monthly basis. For some, it may happen on a 3-monthly basis. The benchmark Nifty 50 usually rebalances every 6 months, where some well-perform good some stocks that were performing well will come into the index eventually, and the ones that were not performing so well will exit. So that is fully the call of the investor or fully the call of the fund manager who manages that fund. So during this time, the investors can choose to redeem their money from that fund, or if they feel like the conviction of the fund manager in that particular sector or in that particular fund is good, they will continue to invest more. And what essentially makes this cycle efficient is the fund manager's role in active decision making. So there's something called active and passive funds, direct and regular funds, which we will see in brief later on. So the efficiency of this cycle pretty much lies in how well the fund manager is able to make decisions for his fund, because that is what is reliant on the returns that is generated, right? So the fund manager has to monitor the fund regularly. He has to make decisions actively, and he has to adapt to all of the market changes, the economical changes, geopolitical changes that are happening around him. So this working model is what makes mutual funds an efficient and a hassle-free way, gives everybody a hassle-free way to access the financial markets. Right, so keeping this cycle in mind, let's look at the various categories of mutual funds. So mutual funds are classified based on asset class. They're classified based on investment objectives. They're classified based on structure. They're classified based on risk and based on portfolio. And there are other specialized funds also. So based on asset class, this equity funds, there's debt funds. Money market funds can be classified under debt funds itself. And then there's a category called hybrid funds. Equity funds predominantly invests in equity stocks or shares, and they are considered to have high risk. Of course, volatility considered, equity funds usually have high risk. I'll give you some examples of equity funds. HDFC Focus 30, DSP Top 100, Franklin Blue Chip, ICICI Blue Chip. All the common fund names that you hear, they're all equity funds. Second, we have debt funds, which invests in fixed income securities. And usually debt generates a return anywhere between 6.5% to 7%. And the risk is relatively lesser compared to equity funds. Money market funds, which can also be classified under debt funds, they basically invest in highly liquid, short-term instruments that can be easily redeemable into cash. So if people want to park their money temporarily for a certain goal, they will put it in money market or liquid funds. Hybrid funds are those that optimally mix equity and debt, which sort of bridges the gap between the two. Right. So these hybrid funds They take the advantages and disadvantages of equity and those of debt. So for example, there's a multi-asset fund or there's a balanced advantage fund. So these funds, they will play out in the market based on the market cycle, keeping in view how equity and debt also performs. Right. Next, we look at mutual funds based on investment objective. First, we have growth funds, which invest, say, considerably in growth sectors, which are suitable for those who have surplus idle funds, right? And then there's income funds, which belong to the family of debt mutual funds itself, and it provides the investor with a sort of steady income stream. Debt, liquid funds, etc., are usually supposed to give you a steady income stream as opposed to equity. Liquid funds, again, comes under debt itself. It invests in debt instruments or money market funds with a tenure of up to 91 days. And the basic difference between liquid funds and other debt funds, it essentially lies in how you calculate the NAV. And then you have something called tax saving funds, which is now called ELSS, equity linked to, right? Or to make the tax compliances easier. So this basically invests in funds that maximize your wealth while also saving in taxes, which is predominantly in equity. Every AMC has an ELSS fund. It might not go by the name ELSS exactly. Some may call it equity income fund, etc. And then we have aggressive growth funds. These basically are designed to, the name as it's suggesting, aggressive. It is designed to make sort of steep gains, monetary gains, and are very susceptible to market volatility, which can be gauged using the market beta value. Right, beta is usually for measuring market volatility, how much the market has gone up or how much the market is coming down, etc. And then you have multi-asset funds, and then you have balanced advantage funds, which invests in a mix of equity and debt funds. Right. Next, we will look at funds based on structure. So you have something called open-ended mutual funds, and then you have closed-ended mutual funds. And then you also have interval funds. But the most commonly used terms, or the most commonly heard terms, are open-ended and closed-ended. So essentially, open-ended funds are what we know as mutual funds, right? They're not traded publicly. But what you have to keep in mind is they have no limit, or there's no cap on the number of units that they can issue. And the NAV changes daily because of the movements in the fund share or stock prices. Right. So open-ended mutual funds are traded on demand at their NAV, which is, like we discussed, it's determined by the fund's underlying market value, and funds underlying securities calculated at the end of each trading day. And the units in this mutual fund are essentially bought directly from a fund by the investors. Right. And what happens in open-ended funds is that the investments are valued at fair market value and the closing market value of listed public securities. So these funds are not restricted. Right. On the other hand, if you look at a closed-ended mutual fund, so these funds, they have a predetermined amount of fund units that are exchanged on a stock exchange. So these funds operate more like ETFs, exchange traded funds, than a mutual fund. They are issued through an NFO, new fund offer, to raise funds that are traded on the open market, quite similar to stocks. So while the fund, fund's worth is based on NAV, the fund's actual price is proportionate to supply and demand. So because of that, the funds can trade at a premium or discounts to their net asset value. Right. Some advantages, if you may want to know about open-ended open-ended funds are. Open-ended funds, they're highly liquid. So investors can redeem these units at any time. There's a certain amount of flexibility that comes with it because there's no fixed tenure. There's continuous entry and exit options that offer better control for the investor over their investments. And closed-ended funds, if you look at some of its advantages, it has a fixed investment period, which encourages that discipline and makes you stay invested for the long-term wealth creation journey. And a lot of the fund managers, they can focus on long-term strategies without worrying about frequent redemptions, etc. Long-term objectives. And interval funds are basically, they're both open and closed-ended. They are open for purchase or redemption only during specific intervals. Otherwise, no. And then you have specialized funds. So we look at something called a sectoral fund. Sectoral funds, they invest in specific sectors, right? So there'll be a certain sector that will be performing well. Right now, we have, say, a banking consumption that's doing well. We see pharma is overvalued. So depending on how each sector is performing, that fund manager will decide to invest in stocks or units in that sector. So some examples of sectoral funds, maybe say an HDFC banking fund, Invesco Financial Services, say a Mere consumer fund, or there's a pharma fund, HDFC pharmaceutical fund, etc. So these are what we call sectoral funds. Sectoral funds are highly of the sector. So the sector is doing well. If the cycle is playing out well, the fund will do well. If not, the fund will not. So it typically depends on the fund manager's conviction and his confidence in how that particular cycle will play out. And that's how the fund managers invest in funds like this. And then you have index funds, which typically replicate a benchmark. So an index fund, it identifies stocks and the corresponding ratio in the market index, and it puts money in similar proportion in similar stocks. So if you look at a large cap, say an HDFC large cap fund, it will be very similar to the holdings of Nifty 50 because that is the large cap benchmark. It may not exactly replicate it because it's an open-ended mutual fund. Say take an HDFC Nifty 50 index fund. That will look exactly similar to the Nifty 50 index itself. And even the percentage of holdings of each of these stocks will be very, very similar, barring like a 0.01% difference in the holdings. So it wants to replicate the performance of the benchmark. And then you have something called fund of fund, which is like a multi-manager mutual fund, and it invests money in a diverse category of mutual funds. So it invests in mutual funds itself. So how mutual funds. And then you have something called emerging market funds, where the index fund identifies stocks and their corresponding ratio in the benchmark, and it puts money in similar stocks. Right, and it puts money in the emerging stocks. And then you have global funds, which invest in companies located anywhere in the world. Finally, based on portfolio, you have something called active and passive mutual funds. I'm sure a lot of you may have heard these terms before. The major difference, the predominant difference between an actively managed mutual fund and a passively managed mutual fund is the presence of a dedicated fund manager who makes active decisions. So in an active fund, there is a dedicated fund manager who decides which stocks will go in and out of the portfolio of the equity fund according to the performance of larger markets. Right, and this fund manager also needs to decide if the existing stocks will remain in the same concentration, or does the holding size or holding proportion need to be reduced or increased? I'll give you a recent example. Recently, IndusInd Bank fell over 20-25%. Whichever active fund had that holding, since the fund manager had direct control over the holding of that stock, he was able to adjust that holding, because of which the performance of the mutual fund did not get as affected as the index did. So because the index had, say the Nifty 50 index had IndusInd Bank and it fell over 25%, Nifty 50 index also took a big hit. And because that is only replicating the performance of the benchmark, the fund manager did not have any discretion over changing the holding of that particular equity stock. So this is the biggest difference between active and passive portfolio. The fund manager actively decides which holdings to keep, how much of it to keep, whereas in a passively managed portfolio, it just works around the performance of the benchmark and the portfolio of the benchmark. Since what goes in and out of the index is not at the discretion of fund managers, but SEBI, which is Securities Exchange Board of India, the fund just directly gets mapped to the movement of the index, which is what I mentioned. So the returns of the index are translated into the returns that the ETFs make. The only difference could be in terms of expense ratio charges or management fee, etc. So now that we know the various categories of mutual funds, what we will discuss next is the advantages and disadvantages of investing in mutual funds. Before I discuss further on this, now that we've spoken about some basics of mutual funds and how it works, can some of you would some of you want to try and sort of think about how mutual funds may be advantages or disadvantages in one's investing journey? Feel free to put your answers in the chat box. Does anybody want to try as to what may be some advantages or disadvantages of investing in mutual funds? Feel free to put your answers in the chat box. Diversification, yes, 100%. Anything else? Fund maintained, correct. It's managed by an expert, correct. Okay. So the first advantage, of course, is diversification, because it invests in a wide range of securities and it reduces the risk associated with just investing in one individual stock or one single investment. Second, we have professional management. So if you look at an actively managed fund or a regular fund, these are all managed by experienced portfolio managers who make informed decisions and They actively decide on what to bring into the portfolio, how much of it to keep in the portfolio, etc. So this professional management goes a long way when, uh, you know, when you're managing other people's money, right? You may be scared to manage your own money, but when there's a certain level of professional advice that is coming in, you definitely feel a little bit more at ease because you know that your money is being managed by a professional. It's going the right direction, right? It provides flexibility. It's affordable also. You can start investing with as small as 500 rupees. SBI has also launched 250 rupee SIP. So you don't, so that, misconception of having having to have large sums of money to start an investment or to grow your money over time is something that needs to change. You can start with as less as 250 or a 500 rupee SIP, and that can do wonders for you over time. And before you know it, you're achieving one milestone after another. And then, of course, there is a certain level of transparency, in terms of regular disclosure of holdings, performance, fees, which helps to make the investors informed decisions. Even though you know that your money is being managed by a professional, that professional also needs to be transparent with you in terms of what he's putting the money in, how much returns it may give you, uh, in terms of fee. As an investor, we are all entitled to have such information before we even decide to do investments, right? And then, of course, there's convenience. It's mutual funds that essentially simplifies the whole investment process, and it allows investors to automatically invest and withdraw funds. Does anybody want to take any guesses on what some disadvantages might be? Low risk, 100%. Equity funds do carry risk, high risk. Debt mutual funds are relatively the ones that carry relatively lower risk. Any guesses on what some disadvantages might be? In the interest of time, I will move on. First is market risk. Can fluctuate with the market conditions. That may work in your favor, may not work in your favor, but it's definitely a risk. And then when you look at debt funds, there is interest rate risk. So bonds are particularly sensitive to interest rates, right? Which can affect their value. Now that RBI has cut rates, the Fed is also cutting rates. So you have been able to see a lot of volatility in the markets as well. Credit risk, this is again more specific to debt mutual funds. Bond funds, they face the risk of issuers, they default on payments, especially on high yielding bonds. So if that credit worthiness is not satisfied, then, or it's not met, then it's definitely a risk to invest in something like that. Management risk in terms of the decision that is taken by portfolio managers. Sometimes it may not be up to the mark. You may not find it your style as an investor, so you may want to change. And then, of course, expense ratio is something that we have to talk about. The fees for management and administration is essentially a larger chunk of money that goes out of your return. So it can erode returns, particularly in funds with high expense ratios. The funds that have higher expense ratios are those that have professional management. So if you compare a direct fund versus a regular fund will have a higher expense ratio because it involves professional management. Whereas in a direct mutual fund, you are at the helm of decision making and not the fund manager. In a regular fund, the fund manager is making all the decisions. So the expense ratio is higher. Fund manager bias is a very interesting point that you make. Definitely, because which is what I covered in management risk, that there will be a certain level of bias if the fund manager thinks or he's working with his colleague, etc. He may be biased towards a certain stock, he may be biased towards a certain sector, because of which he may hold a larger portion of that in his portfolio, which may or may not work in his favor, right? So fund manager bias plays a very, very important role. So now that we have a fair idea of the advantages and disadvantages of mutual funds, let us look at the two modes of investing in mutual funds. Of course, I'm sure many of you have in mind SIP and lump sum. So before I speak about SIP and lump sum, I'll just quickly talk about direct and regular plans, right? So in a direct plan, you invest directly with the mutual fund company. So there is no distributor intermediary commission that's involved. What does this mean? That your expense ratio is relatively lower and your returns are slightly higher in the long run. Maybe. In a regular plan, you invest through a mutual fund distributor or advisor who sort of helps you choose the right fund in exchange for a certain amount called commission. Structure is what differs. These can be growth or dividend oriented also. Growth plans reinvest returns back into the fund, compounding over time, but dividend plans pay out regular income to the investor. This is essentially the difference between a direct and a regular fund. If you have been following ithoughtmfd, last week or the week before last, I had done a webinar centering fully on direct and regular funds. I will put the link of that in the chat box so we can send the link across to all of the leads. Post the webinar if you want to take a look and understand more on direct and regular funds. So having the presence of professional advice and another mode of investing, of course, is based on how much you're able to invest, right? There's something called an SIP and there's something called a lump sum. Lump sum is when you get, when you invest a large amount at one time. Say you get a bonus at work, you get a little seed money from your parents and you don't know what to do with it. You might be itching to spend it on something for yourself or some brand that you've had your eyes on for a while, etc. Instead, if you put that chunk, say that bonus of 50,000 into a mutual fund, that will do wonders for you, right? And lump sum along with SIP is, of course, the magic to your first crore. And this lump sum investment is suited for investors with a higher risk appetite and a longer, term horizon. SIP, on the other hand, it allows you to invest smaller amounts at regular intervals, typically monthly, right? As somebody who's starting out, you may have just started working, may have just started earning. You have to send back a certain amount home for your parents. You may want a certain amount for your, daily routines. You might want it. You might want some money for food, some for rent, other fixed expenses, etc. Over and above which you should definitely consider, say, if you're able to save 5,000 or 3,000 a month, you should try and save that 3,000 consistently every month and start investing in a systematic investment plan, which we call an SIP. And SIPs are essentially great for building investment discipline and reducing the impact of market volatility through something called rupee cost averaging. So over time, you may have just invested 3,000 every month, but if you look at your corpus, say 5-6 years down the line, you may have accumulated a few lakhs, right? And plus returns, you may have just built yourself a huge amount of money, and you will definitely want to make that amount higher. So these are some common ways that you can invest in mutual funds and how you can invest it. Now that you understand, how how a mutual fund works. Just a quick background about how mutual funds even came into existence in the first place. So the history of mutual funds essentially goes back to 1963 with the establishment of UTI, which is also an AMC right now. So UTI, it basically held monopoly till 1987, after which, public sector banks and a lot of financial institutions entered the market. And as we're all aware, after the LPG movement in 1991, which is liberalization, privatization, globalization, the industry expanded further with the entry of private sector mutual funds. And consequently, the formation of SEBI in 1992, they introduced regulatory reforms, enhancing transparency and investor protection. So today, India has a with flows coming in left, right, and center into all types of mutual funds. So this was a quick background on how mutual funds even came into existence. If you're all following the markets, you may definitely know the existence of an AMC called UTI. They held monopoly, and of course, rest is history. So that brings me to the end of the presentation and the webinar today. I'll open the floor for questions, any questions that you have. You can feel free to put your questions on the chat box, and I will be more than happy to address them. Your opinion on markets may go sideways. Specialized, so SIFs, AIFs is something that definitely needs professional management. Minimum investment amount that comes with it. It is definitely better to okay. I will get back to you on the SIF front. Sir. What is your advice on why an investor should choose a mutual fund SIP? Simple reason, stock, like I said, is an individual investment, right? So immediate volatility affects your portfolio largely. In a mutual fund, what happens is there's a collection of stocks. Even if that, say, one or two stocks don't perform well, there are other stocks in the portfolio which will compensate for it. So maybe to start with, you can start with a mutual fund SIP. And as your risk appetite grows over time, you can definitely do a stock SIP. For the initial few years, maybe mutual fund SIP will help you gain that confidence in wealth creation. For the next 5-year horizon, which type of mutual fund is good to start SIP? What is ready to take risk? That's great to hear, sir. If you're ready to take risks, you can look at some sectoral funds to keep your portfolio a little steady. You can also look at some large cap funds. You can reach out to us on this number, and one of our financial advisors will get in touch with you, and we can start off your SIP as soon as possible. So it's great to hear that you're ready to take the risk. And in this type of a market, it is the quality that we're also looking for. So it will be a great journey. You can get in touch with us by contacting us on this number, and our financial advisor will definitely get in touch with you and help. How to select the correct fund and correct fund manager? That depends on what your investment goal is. It differs from individual to individual. I will take both questions together. The next question is, what are some of the key criteria to focus on when selecting a good mutual fund, right? Past performance is definitely not the only thing that you look at. You have to look at how the fund manager is running the portfolio, how often it's being rebalanced. You also have to look at what the philosophy of the AMC is. Does that align with the philosophy of the fund manager? As the mutual fund distributor, we also have to look at whether those two philosophies align with what we want to do as a distributor and for our clients. So there's no one single metric. It has to do with a lot of things put together. Just looking at past performance and past numbers is definitely not the only thing that you should be looking at. Like I mentioned, you should be looking at how the fund manager has been doing in the past, if there's been any change in the fund manager. A change in the fund manager can also bring a change in how the fund is being run, right? How the portfolio is positioned. Is it a very risky portfolio? Is it something that you can stay invested in for a long term? All of these decisions will differ from investor to investor because it's not a one size fits all approach, right? Each investor will have a certain risk appetite or a certain mindset with which they would want to invest or a certain goal that they would want to invest with. So there is no one size fit all approach. There's no one single way to determine this. This will differ from individual to individual. How to contact for milestones to wealth? Can you share more details about it? I will put the contact for N2W on the chat box. So feel free to reach out to the team anytime. That would be the contact for milestones to wealth. Which type of mutual fund investment would you recommend to achieve the goal of funding a 6-year-old education? You can start with equity investing as soon as possible. You can start with an SIP. You can get in touch with us and we can get you through the whole process. Why is some funds performing better and suddenly not? That is predominantly not, which is affecting portfolios. But right now, it's good to be bullish on, as a house, we're bullish on, say, large caps. We're investing in banking, consumption. These are some sectors that we are bullish on, that we would like to participate in. And we generally like to stay out of those pockets of the market which are rather risky. So performance right now is fully a certain by market volatility. Markets are extremely volatile and will continue to be volatile for the next few months. So you may want to watch out for your investments and maybe redirection it if you feel the need to do so. And we're here to help. Feel free to contact us anytime and we will get in touch with you. The number on the slide is also the number to milestones to wealth. So you can reach out to us and our team will get in touch with you and we can get your investments underway as soon as possible. Predominantly because of the risks involved. Like I mentioned, we don't want to participate in those pockets of the market that are very risky at the moment. Small cap, multi-cap are extremely risky, although the flows are coming. It's a very temporary sort of situation, right? It's not going to help you at least at the moment in the long term, because it's a very volatile sector, which is why we are more bullish on large caps. You may hear a lot of people talk about that, how you should invest in small caps. It's extremely risky, but rewarding. If you have the ability to take that risk, we're more than happy to help you with it. But as a house, we do not wish to participate in those pockets of the market that are rather risky because we're dealing with other people's money as well. it's not everybody's cup of tea. So if you think it is yours, it's definitely something that you should consider. The not good to start since it's risky. All that better now. What about SBI contra fund? Because it's a PMS at the moment, I will probably get somebody from the team to get in touch with you for more clarity on PMS. What about SBI contra? As a house, we do follow a contrarian approach in general to our investments itself. So we don't find the need to invest in other contra funds, but it is an approach that even we follow. Yeah. So we will enter that segment of the market when nobody is looking at it, and then we exit once it's peaked. Like in general, that's the theme of the house also. So it's not a bad space to be. Okay, great. If you have any more questions, you can get in touch with us with the link on the slide. I've also put the number in the chat box. Feel free to get in touch with us at any time. Our team will get in touch with you, and we will be more than happy to help you start your investments. And we hope that a lot of you will get in touch with us for your investments. Thank you so much once again for joining us on a Saturday morning. It really means a lot to us. And we hope to see you in